Alright folks, welcome back. This is the price action model number 6 universal trade plan, focusing primarily on the buy side of the market maker models. Okay, ICT price action model number 6 universal trade plan, buy side of the market maker models. Every trade plan video has this as well. It's the overview. So in each trading plan we look for the 5 stages here: preparation, opportunity discovery, trade planning, trade execution, and finally trade management. Alright, for preparation, we're going to note all medium and high impact events for the markets that you're following. We're going to study the events on the week to come and consider how the current market structure and the calendar events may suggest a specific weekly profile for that week's range. We're going to determine the IPTA data range for the last 20, 40, and 60 days. We do not count Sundays, and note the highest high and the lowest low in the past 20 trading days, and this is your current dealing range. The reason why we're going to be looking at the 20, 40, and 60 is because this is a universal trade model, so it's allowing us to trade in multiple time frames. So this begins with the 20-day look back, and then 40-day, and then 60-day, depending upon what time frame you're using. So if you're using like a weekly setup, or if you're using a daily setup, or a 4-hour, 1 hour, that type of framework, you're going to look at the longer term for a weekly chart. In other words, we'll look at the 60-day look back, and that will be attributed to weekly setups. Daily setups can be 40 to 20, and sometimes 60 days, depending upon if you've gone outside the range. But the point is, you're going to define the last 20, 40, and 60 trading days, and you're going to determine that range, the highest high and the lowest low. Splitting that range in half gives us our premium and discount PD array matrix. So we're going to be looking for primarily buying in discount ranges. Okay, inside this dealing range, we're going to look for the next draw on liquidity. In this case, where is price likely to trade to next above which old high? We look for a premium PD array in the direction of our weekly range bias. Now, you understand enough about the market maker buy and sell models to know that when we're looking at the market maker buy model, the original consolidation, we start near the low or inside of a discount market. The market will trade up to a premium, reverse, and trade lower and go below the original consolidation. In a market maker buy model, it starts at a premium consolidation, it declines down to a discount where it reverses and trades back above the original consolidation. So we're going to be looking for that premise on the time frame that we're studying for our setups. Okay, we're going to anticipate price to move to a premium PD array that would support our weekly bias on a day and economic event found on the economic calendar with the current or next trading week. This volatility injection is what we wait for. This will be a run on the basis of a low resistance liquidity run. Okay, opportunity discovery. The image to the left is your mental framework on how the trade should pan out. And this is an example of a market maker sell model where it goes up first to drop down. You're going to identify a premium PD array above the market. In this case, it may be a bearish order block or a bearish breaker that you expect the market to trade up to and then react to going lower. So the framework on this is directly linked to your understanding on how the market's going to swing higher to make a sell opportunity, Not just, okay, it's a sell right now because I'm looking at the marketplace. You need to be able to forecast that the market is at present market conditions and market pricing. You expect the market to rally up. Once it goes up to a specific premium array, and again, as it may be a bearish breaker, bearish order block, it might be running an old high for like a turtle soup, and then sell off. Okay, so it's not like you're just waiting for it to keep going up in perpetuity. You're waiting for it to go up, and in that movement from current market action and pricing up to that premium array. In other words, think of it as we're in an oversold market, okay, and we expect it to trade up to an overbought condition into a resistance level. Now, they are retail terms, but we look for things that are narratively driven, and we're going to look for stage 1 or stage 2 of reaccumulation to go long and target the terminus at the premium PD array. Now, terminus is where you think the market's going to go up to, stop, and turn around and go the other direction. So it's important to understand that we're not getting in this trade with the idea that it's going to explode and become a mega trade and go, 3, 4, 5 months in one direction. We're looking for a very scalable, forecasted move that sends price higher, but generally up to a point at which it creates a sell. So in this trade plan, we're focusing primarily on the buy side of the curve of both the buy and sell models. Okay, and the reverse is seen when we have a market maker buy model. We're going to identify a premium PD array, old high, or in this case, the original consolidation above the market. That price will likely reach up to complete a market maker buy model. Again, we're going to wait for stage 1 and or stage 2 reaccumulation period to go long and target the terminus at the premium PD array. In this case, because it's the market maker buy model, we're going to be targeting the premium array in the form of old high or relative equal highs that would describe the original consolidation prior to the drop down and then reversal. And when it starts to go up, that's the buy side of the curve of a market maker buy model. We're focusing primarily on that. So you wouldn't be really trading with this plan as it goes short. You're just waiting for it to trade down to that discount array, create a market structure break to the upside, and then you would start looking for regions to be long in stage 1 or 2 reaccumulation. Trade planning. When the market is primed to rally higher, we want to look for a convergence of both manipulation and price, opposite to our trade bias, in this case, something dropping lower for a Judas swing, at a time that the economic calendar suggests a volatility injection will likely unfold. We will buy discount fair value gaps or buy sell stops in a stage 1 or 2 reaccumulation. When we are bullish, we will frame a long entry when price has moved down into a 15 or 5 minute discount fair value gap PD array that converges with a standard deviation of no more than -3 standard deviations during London Open or New York Open. We can implement scalping protocols on this stage as well for further reduction in risk. When we are in a market maker sell model, we will target the buy side liquidity above the old high as terminus. If we are in a market maker buy model, we will target the original consolidation of the market maker buy model. When we are bullish, we will anticipate a 5-minute chart institutional order flow entry drill, trade entry to form inside of a retracement lower during London Open and or New York Open kill zones, or a sell stop raid that will go long when it unfolds. When we are entering a long, we will place a buy limit order on all positions we will execute with our demo account. We will use the standard deviation and PD array convergence plus 5 pips as our entry price when using the buy limit order. If multiple orders are used, all use the same entry price in the buy limit order. When we're entering a long, we will place a limit order to take 20 pips as our objective on one position. We will place a second limit order to take 40 pips as our second objective. We will use multiple orders to manage the trade idea. If you capture 60 pip objective, and this is assuming you have at least 3 positions on, or 3 trade entries, separate orders, you're going to close 80% of the trade and see if it has more room to run. When we are entering a long, we will note the discount array and standard deviation convergence we aim to enter at. We will place our stop loss below this low, minus 20 pips. We will re-enter if the trade stops out. We can monitor it for secondary entry. Day trades may require multiple attempts to secure a solid entry. Do not fear that. When we are in profit 25% of our expected objective, stop loss can be reduced by 25%. When we are in profit 50% of our expected objective, stop loss can be reduced by 50%. When the position is at 75% of the expected profit objective, stop must be at break even. Now, when you look at this, it seems like you're holding a lot of open risk. But remember, we're taking something off at 20 pips, we're taking something off at 40 pips, and something at 60. 80% is coming off. And in the remainder, there isn't much risk remaining in the trade because we're banking as we go further in progression. Money management. Now, obviously, these slides don't change. Position size calculation formula is position size equals account equity times risk percent divided by stop loss in pips. Position size is the amount of leverage your trade or trades assume. Account equity is the total amount in your trading account. R percent is the percent of risk you are willing to take on per trade. Now, if you're using multiple orders, you have to divide that in the total number of orders you're going to have. So if you're willing to risk 2%, and you're going to be using 4 orders, let's say. So 4 separate orders at 1/2 of 1% would give us the same thing as 2% risk. The difference between the entry price and your stop loss is the number of pips you will use to divide the result of equity times R percent. As an example, equity of 20,000 US dollars. Risk per trade is 1.5%, or 20,000 times 1.5%. In this case, it would be 300 US dollars. Stop required for the trade is 20 pips. In micro lots, 1,000 each, or 10 cents per pip. 20 pips times 10 cents equals 2 US dollars. So $300 divided by $2 equals, you can have a 150 micro lots per trade, or 1.5% of the account equity, always round down. Next example would be using mini lots. Same idea, 1.5% with $20,000 as your equity base. Each mini lot is 10,000 each in leverage, or $1 per pip. 20 pips at $1 per pip equals 20 US dollars. So $300 divided by $20 for a 20 pip stop loss at $1 per pip equals the same thing as 15 mini lots per trade, or 1.5% of the $20,000 equity. Again, always round down. And finally, a standard lot would be $100,000 in leverage, or $10 per pip, using a 20 pip stop loss in this trade plan. At $10 per pip would be a risk of $200, and with $300, which would be a maximum of 1.5% of $20,000, would be $300 divided by 200, and that would be 1.5 standard lot, or in this case, 1 lot per trade, because you can't break a standard lot up. So that's why we like to use minis. Always round down. Mini lots are always more flexible. If your demo account takes a loss on a trade and is at a full R percent that you assumed, you're going to drop your R percent by 50%, and when the loss is recovered by 50%, you're permitted to return to the maximum R percent per trade. This is to say that if you lost $100, okay, you cannot trade the same amount of leverage that you used when taking that $100 loss until you make $50 back in new profit. And then you can round back up to the same leverage you were using before you took the $100 loss. If you reduce the R% trade and it assumes a loss as well, you reduce the R% by 50% again until the previous trade loss is recovered by 50%. If you take a series of 5 winning trades in a row, drop your R% by 50%. You're likely to assume a loss eventually, and this will build in equity leveling and reduce the likelihood of a large drawdown. You want a smooth equity curve that slopes or stair steps higher, not a jagged roller coaster with deep declines. Alright, so now you're going to start back testing. You're going to collect multiple sample sets with this trade plan. If you're unclear about some of the process, rewatch the lessons in this price action model. I'll provide sample sets. Do not rely or wait for mine. Dig into your charts and study what was provided here. Until next time, I wish you good luck and good trading.